My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Clean up in aisle 7. When you hear that in the supermarket, it can mean one of two things. Either you have to brace yourself for the mess because you need something from aisle 7, or it means nothing because you're not in that aisle and you have no reason to go there. That's this stock market in a nutshell. On a day when the Dow lost 86 points, S&P advanced 0.18%, the Nasdaq actually rallied 0.74%, with the S&P and Nasdaq setting new record high closes. We've got a series of aisles, some of which badly need cleanup, namely the industrials and the financials. But other aisles still have high demand, and it's tough to keep the merchandise on the shelves. Here's the problem. Most people insist on seeing the stock market as a totality rather than a market of thousands of different stocks. It's like the supermarket. See, there's the freezer aisle. It's not the same as the fresh produce aisle, right? They're different. But you often hear people treating them like an undifferentiated mass. When really rich money managers come on our air, their funds are so big that sometimes they can only be meaningfully trading the entire market, the S&P. They'd overwhelm most individual stocks if they tried to take a sizable position. So it's easier for them to flit in and out of the S&P 500 futures, which contain every aisle. You don't have to do that, though, right? You can just avoid the messes and head straight for the clean aisles that are staying strong. If you get a cleanup on aisle 7 situation that takes down the entire market, think of it as a buying opportunity for the other better aisles, or entirely, if you really want to own one of those messed up stocks, maybe they're too low and you can do it. So what's the difference between a good aisle and a bad aisle? You get a crowd stuffing their carts with anything that moves in the senior and junior growth stocks right now. That suggests the economy could be cooling down, or the Federal Reserve might be about to slam on the brakes to tamp down on inflation. Too many rice cakes before the show. Once the Fed starts a tightening cycle, money managers start to swap out the cyclical boom and bust stocks, and they swap into the secular growth stocks. That playbook was a huge driver of today's action, as swift traders are trying to get ahead of that call. So what they're doing, they're selling these now because they think others are going to sell them later. Then there are the aisles where the jars are smashed and there's liquid all over the floor. And boy, that was the industrials today, where the glassware is flying all over the place and there aren't enough mops to clean up everything. Oh boy, that was the bank aisle, where people were slipping and falling after J.P. Morgan Jamie Dimon talked about a 38% decline in trading revenue. Ouch! That's much lower than expected. Of course, once one jar gets knocked over, it tends to take down everything else in the aisle, which is why both Goldman Sachs and Bank of America got hammered too, even as the latter told a very positive story this morning on Squawk Box. I don't know if you caught it. It was really good. That ugly trading number from J.P. Morgan is a serious mess. It's a real problem. So you have to expect some analysts are going to cut numbers and maybe even downgrade the bank stocks tomorrow. That's why you can't get ahead of these things too quickly. But how about the other aisles? See, for the most part, nothing really newsworthy happened. That's what makes some of these moves so disconcerting to people. For example, no one said boo about Caterpillar, yet its stock fell for the 4th straight day. Now, some might say that's because Biden's infrastructure bill is stalled. Cat's now down nearly 30 points from its highs. But I think that misses the real driver. To me, Cat's falling because there's a perception that the Federal Reserve will have to change its posture at Wednesday's meeting. Now, I think that's wrong. But a lot of people are assuming Jay Powell will have no choice but to tighten after last week's red-hot consumer price index number. That's why the Dow Industrials really got hit today, but not the Nasdaq. The Dow is full of stocks that would be crushed if Powell gives the inflationistas what they want. That's this group, okay? This group actually does well on that, but I'm really focused for a moment on these. These people need to listen to what Powell actually says, rather than presuming he'll stick to the Fed's old playbook. See, I've really got to make this point. See, Powell's different. He's thrown that playbook out the window. I think Powell's very committed to an easy course, even if you believe inflation's out of control. He wants to keep rates low so that the unemployed and the disenfranchised get decent jobs. If the cost of a stronger labor market is above average inflation, so be it. Whether you agree with Powell or not, he's been very upfront that this is the plan. So I'm willing to wade into the beaten down industrial aisle and start picking up bargains tomorrow, while the mess has still yet to be cleared. This group, not this group. But how about the aisles that are bustling? All right, what's there for you if you, like me, you believe that inflation is running its course and the Fed knows what to do? Well, okay, so let me introduce you to these two terms. These are really what's driving a lot of stock market action right now, and a lot of people don't know them because they've gone out of style. I want to bring them back, all right? Right now, there are senior growth stocks and junior growth stocks. As much as I love the term FAANG, that is my acronym for Facebook, Amazon, Apple, Netflix, and Google, I think we need to broaden it out. Call them senior growth stocks because there are so many other senior growth stocks that are now being put in the cart. For example, we had a big move in Adobe ahead of its earnings on Thursday. That counts. This stock, which had lost its lift not that long ago, actually hit its all-time high today. It better be good when it reports. Microsoft works. NVIDIA, right? And after a long dormancy, Salesforce is starting to run too. When the banks plummet, the money flows into the financial technology plays. Banking light, so to speak. So that means Square and PayPal see panic buying. Maybe fintech should have its own aisle. Then there are the junior growth stocks, smaller and faster growing than their senior components. Now, there's, for instance, these stocks have been roaring. There's Twilio, the fantastic company that lets app developers push messages to the customers, among other things. There's Roku, which is the cord-cutting kingpin. CrowdStrike, we just had them on, right? They stopped crypto kleptos. Etsy, the online marketplace for all sorts of handcrafted goodness based in Brooklyn. And DocuSign, which has become the de facto way to close deals over the internet even after the pandemic. Junior growth stocks are beloved by Cathie Wood of ARK Invest, who had an incredible year in 2020 but was struggling in 2021 until recently. Often she seems to keep these stocks all by herself. Now, I am not against FANG and friends. I've been a huge supporter of the senior growth stocks, especially Amazon. But I'm beginning to believe that it's time to examine the stocks in the godforsaken aisle where people keep slipping on copper and lumber and iron ore, because now those stocks are going down. If you think, as I do, that the Fed will keep the fires going, you want to own a steel stock or a heavy machinery player or a chemical company. Cleveland-Cliffs, it was down $2 today. Could go down under 20. You got to probably buy it then. If Caterpillar comes to 200, I mean, come on, let's buy that one. Dow Chemical, good yield. I even sanctioned some energy stocks because many of these companies have changed their suboptimal ways. Chevron, Pioneer, even Exxon. These are the kinds of companies that thrive when economies around the world are growing. And that's exactly what I expect. But the bottom line, until we see the Fed's eyes on, and that's, of course, the whites of their eyes on Wednesday, you can expect the action to look like today, where we had lots of traffic in the junior and senior growth aisles, with shoppers fleeing from the messy industrial and, yes, bank stock aisles.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.